Welcome to this video on capital budgeting. In this video, we are going to talk about capital budgeting, which is the planning process for the acquisition of large capital assets. There are various topics covered in this video. First, we are going to talk about what capital assets are and what capital expenditures are, as well as the need for capital budgeting. Then we are going to talk about the capital budgeting process and also the capital asset financing options. The last three topics, that is compounding and discounting interest, net present value and cost-benefit analysis, all relate to monetary values over time. Note that we have seen a previous video where we distinguished between real and nominal values. You will see that the topics associated with interests and net present value is going to be slightly different. So let us have a look at capital assets and expenditure first. Regarding the definition of capital assets, there are two definitions, and those definitions depend on the perspective. There's an economic definition, which basically defines capital assets as assets with a useful life of more than 1 year. From an accounting perspective, capital assets have purchase prices above a certain dollar amount. Think here about very large investments. Usually, capital assets are an input into the production process of private and public goods. You can think about highways, mass transit, railways, or airports as having being private goods, and you can think about schools, hospitals, or recreation areas as public goods. Again, in general, you can think about capital assets as large and non-recurring expenditures on infrastructure. Now, with regard to capital expenditures, those are basically the outlays to purchase a capital asset. And we will see that it is important to realize that when you're purchasing a capital asset, that it produces benefits beyond the current fiscal year. The characteristic of a capital expenditure is that it basically extends beyond the current fiscal year, that it is associated with large tangible projects of high initial cost. And again here, this is a non-recurring expenditure except for operation and maintenance, covered by recurrent budgets. For example, if you're purchasing a bridge, then that would be a capital expenditure, but the maintenance and the road repair, that would be covered by recurrent budgets. There has to be a match between current service provision and current expenditures. So if you are investing in a capital assets, and you borrow to support the capital expenditure, then that is because the capital asset provides services over multiple years. And hence you also want to pay the expenditures associated with it over multiple years. Now, here are some examples about capital assets and expenditures. You can think about this as land or land rights purchases. You can think about capital assets as buildings that have usually a very high construction cost. And note that capital expenditures would include the legal, architectural, and also, for example, the engineering services. Infrastructure such as highways, airports, bridges, tunnels, and so on. But it can also be smaller items such as equipment and machinery. This would include automobiles or computers for the office. So why do we need a capital budgeting process? First of all, if you're investing in a capital asset, then the investment is permanent in the sense that there are long-term consequences. The capital asset provides services over multiple years or even decades, and hence taxpayer payments have to be spread over the capital asset's life for intergenerational equity. For example, assume that you are a city and you are purchasing a new bridge. that bridge is going to be used by everybody, even those residents who move into the town after the bridge is built. Those new residents are benefiting from the bridge, and hence it is necessary that they are also contributing with their tax payments to that bridge. Another reason for the capital budgeting process is that expenditures should be separated between the capital and the recurrent budget, due to the difference between outlays and benefits. Also, there is a risk involved with the purchasing of capital assets. The capital budgeting process is designed to minimize this risk. The potential risks are technical, usually that you cannot apply past experience of, for example, building a bridge in a particular location, and also the expenditures is an irreversible process. There are also financial risks associated with purchasing a capital asset because it impacts future budgets if the capital asset is financed via debt. Basically, the capital budgeting process gives you a long-term perspective on infrastructure. There are also other reasons. Tax rate stabilization refers to the fact that a reduction in current tax burden occurs because expenditures are spread over multiple years. Note that at the federal level, we do not have a capital budgeting process, which is due to the size of the federal government, in the sense that there is no single project that would constrain spending in other areas. Also, critics would say that a capital budgeting process could potentially lead to the tendency to deficit spending if there was a separate capital budget. The same is also true at the local level, in the sense that potential drawbacks of capital budgets have been cited, for example, as being excessive reclassification of operating expenditures into capital expenditures. Also, it could lead to a bias towards borrowing to finance all capital asset purchases. Now, let us look at the capital budgeting process. There are 4 steps in the capital budgeting process, and basically they can be summarized as plan, finance, and implement. The first step is you need a current inventory of capital assets and also a master plan. Second, you need to select the projects, and you also need to incorporate those projects into a capital improvement plan. The next step is a financing plan and long-term financial analysis, and then ultimately you're going to implement the capital budget. Now let us look at the first step. You first need to do an inventory of current assets and also their conditions. Think about a bridge, for example. Then you need to know the age, the condition, the usage, the capacity, and also how much it would cost to replace the bridge. The inventory may also include estimates for renovation or expansion of the bridge. It will also give you a way to think about the possible inclusion of some expenditures into a recurrent budget. Now, the inventory of capital assets also allows you to determine the current service characteristics, in the sense of what is the current and future cost per unit of service. In an ideal situation, you would have an asset management plan that is providing a list of capital assets, their maintenance cost, also their maintenance schedule, and other information. The asset management plan could serve as a basis for deciding on whether to expand or to simply continue with maintenance of a capital asset. Here in this link, you have an example of an asset management plan for a city in Texas. Once you have the inventory, you also need what is called a master plan. Think about this as a broad vision regarding the direction for the local economy, for land use, for development. Basically, you are forecasting the need of future facilities. Think about an expanding city, for example, whether you need new roads, new sewage systems, or new libraries. Those forecasts should be based on the expected community growth and also on the expected economic development. Based on this master plan, for example, if you're envisioning a 20% increase in your population over the next 5 years, then that will also allow you to estimate the demand for services such as parks, transportation, office space, or residential. Below here, you have a couple of examples of master plans that are in Indianapolis for parks and recreation. There's also a plan for the city of Carmel in Indiana, and there's also a master plan for St. Paul, Minnesota, which is called St. Paul for All 2040. Now, let us have a look at the St. Paul for All 2040 Comprehensive Plan. So if you're looking at the document, they are identifying major trends that are informing a comprehensive plan policy. For example, they know that there will be climate change and associated changes in precipitation and temperature. They are aware that there's an aging housing stock and also an aging infrastructure, and that there will be constrained financial resources to pay for city services and facilities. They are also aware of changing demographics. Note that the changing demographics is an issue that has been identified by many cities, in the sense that if you have a more aging population, or if you have an older population, that requires different services, for example, in terms of public transportation. They also identify challenges and opportunities for the future, in the sense that they identify equity, growth, and density as a challenge and opportunity. Also, the economic development, climate change mitigation, adaptation, and resilience. And again, as I mentioned before, designing a city for all ages and abilities. Now, once you have the inventory and a master plan, then you can start selecting projects. For this, you first need to have a list of projects, and then you need to have the project cost. The project cost would involve, for example, research and development, any fees associated with the construction, and then of course the construction cost itself. Then you also need to have the life cycle expenses associated with repairs, operation, and maintenance. The projects should be evaluated regarding the effectiveness compared to renovation of an existing facility. And again, you need to have the project cost and the life cycle expenses also incorporated in the project selection. And of course, the projects have to match the appropriateness given the priorities in the master plan. Now, let us have a look at, once you have those projects selected, about what is called the Capital Improvement Plan. The Capital Improvement Plan is a multi-year plan with detailed project information, documentation about expenditures, about cost, about maintenance, and also the justification of why you're going to have this project implemented. The Capital Improvement Plan should list the new facilities as well as the renovation or replacement of existing facilities. Of course, a very important component of the Capital Improvement Plan is the financial and timing of projects, or the financial information and the timing of projects. There also has to be considerations regarding the sequencing of projects. So for example, if you're planning both a sewer line, a utility cable, or 3 items and a new pavement, then you have to make sure that the sewer line and the utility cables are implemented before the new pavement. Note that the city of Noblesville has a capital improvement plan listed on their webpage. Right? The capital improvement plan can also be potentially updated every year. The advantages of a capital improvement plan are that it has a multi-year perspective, and it also includes long-range policy development. It really focuses the attention on community goals, on needs and finances. But as I mentioned before, a capital improvement plan can be updated every year, and hence it is a dynamic process to also build public consensus based on shifting opinions, for example. It also serves as a financial management tool and as a reporting document. The capital improvement plan usually involves multiple stakeholders. For example, it could be a top-down approach that you have the executive directions based on policy priorities. But then you could also have a bottom-up approach in the sense that you have agencies estimating their costs based on their needs. And sometimes you also have the input or the potential input of citizens or from citizens. Now, let us have a look at the financing plan and the long-term financial analysis. As mentioned before, if you're planning to invest in a capital asset, then you're likely going to pay over multiple years for the cost associated with the asset. And hence, you need also projections of tax revenues and baseline expenditures over years. Usually, there are two financing options associated with long-term assets. There is what is called pay-as-you-go, current revenue sources other than debt, and pay-as-you-use, which match the debt repayment with life of the asset. Note that the pay-as-you-go is usually implemented for capital assets that are of smaller nature, smaller in the sense of lower expenditures. So let us have a look at those capital asset financing options. As mentioned before, we have a pay-as-you-go, which is basically the financing of capital projects with current revenue sources other than debt. For example, if you're having infrastructure investments, you can finance that over motor fuel taxes, or for example, an increase in motor fuel taxes. Other non-debt sources would be grants from the state or from federal government. You can also use accumulated financial reserves. The pay-as-you-use is probably more likely, in the sense that you're financing a capital project with debt. For example, as a municipality, you can issue bonds or other debt instruments that are usually issued by the government. And the debt repayment would be over the lifetime of the asset. And of course, you can always combine the pay-as-you-use as well as the pay-as-you-go. Now, the advantage and disadvantages of pay-as-you-go is that you avoid, since you are not having debt, you are avoiding the payment of interest. Since you're also avoiding debt, you're preserving your borrowing options for other projects in the future, in the sense that it has more flexibility. The disadvantages is that you may have to increase taxes or levy fees in order to finance the project. Also, if you're, for example, utilizing reserves or financial reserves which have been accumulated, then there's a misalignment between the payments and the benefits of the capital asset. It can also lead potentially to underinvestment in capital assets. For example, if you know that your constituents do not like higher taxes or paying fees, and that you are limited in the amount of tax increases, then that may lead to a potential underinvestment in the capital asset. For the pay-as-you-use, here you're using debt. The advantages are, of course, that you avoid tax increases and that there's an alignment between payments and benefits of capital assets. The disadvantage is that you are constraining your operating budget or your recurrent budget due to the debt service. And depending on how much debt you already have, there may be a high debt burden compared to the values of the properties that are, for example, in a particular city. The financial analysis over the capital asset lifetime includes evaluating the revenue capacity in the sense of, does the project have the ability to generate so-called own source revenue? And what is the share of that revenue compared to how much of that revenue is available for capital investments? You also have to think about the borrowing capacity in the sense that if you are investing in a capital asset and you are going to finance the capital asset through debt, then how does the total debt compare to the size of the entity or institution? Entity or institution could be, for example, a city or a county. It also depends on the interest rate and the debt service over the upcoming years and decades. It also influences your credit rating. You also have to think about whether the project can generate user charges or fees to actually pay for the capital asset. There, you would have to project revenues and the share of those revenues that can be dedicated to the capital investment. As mentioned before, there's also the possibility that other governmental entities or private entities contribute to the capital asset. There's federal aid or grants, there are also state grants, but there could also be public-private partnerships. And of course, you want to evaluate what the impact of the capital asset on your operating budget is, in the sense that when you have to pay for maintenance and operation, then that has to be included in the recurrent budgets. Now, let us have a look at the leasing and debt options of a capital asset. Note that here we are going to talk about municipal bonds. Municipal bonds, usually the interest payments are excluded from taxable income. Note that this is valid for the bondholder. Since it is non-taxable, this can also then result in lower interest rates or lower cost of borrowing for the issuer. There are two types of municipal bonds. There's the general obligation bond and there's also the revenue bond. Basically, the general obligation bond is backed by the taxing authority of the government, in the sense that it is the strongest security pledge with very low interest rates. General obligation bonds are also possibly subject to voter approval. The second type are revenue bonds, where the bond or the payments of the bond are backed by the revenue generation of the capital asset. This leads to higher interest rate because there's the risk that the capital asset generates inadequate stream of revenues. Other options may be leasing. Here, of course, this would be for smaller items. Think about, for example, a police car. Could be, and leasing is a useful option for specialized equipment that will likely become obsolete after the leasing period ends. Another option would be directly borrowing on capital markets in order to obtain a loan. Next, let us look at the financial side of things and also to look at values over time or monetary values over time. And here we are first going to talk about compounding and discounting interest rates. So here, let's start with compounding interest. Suppose that we are in the initial situation where we have a deposit of $100 and there's 5% interest over 3 years. So you have a starting balance of $100 and then you're earning 5% interest rate, that would be $5. And so your ending balance in year 1 would be $105. In year 2, the starting balance is simply the ending balance from the previous year. And then you're going to earn 5% interest, which would be, in this case, would be $5.25, because now we are not having the base is not $100 anymore, but it's $105. And hence the ending balance would be $110.25. And the same is true for year 3. And hence, if you're depositing $100 in a bank account with 5% interest over 3 years, after 3 years, you're ending up with $115.76. In general, the formula is that you have the present value, that would be the $100, times 1 plus R, where R is the interest rate, the 0.05, and T would be the number of time periods. So if you were to plug in $100 as the present value, 0.05 as R, and T is equal to 3, then you would have the $115.76 as the future value. Now suppose that we are interested in the opposite. Here we are talking about discounting interest. Basically, the discounting interest is to determine the present value given an amount to be received in the future. So here we are not really calling it the interest rate, but we are calling it the discount rate. Suppose that you want to withdraw $100 in 3 years and that the discount rate is 6%. Now the question is, how much money do you have to deposit into your bank account today in order to be able to withdraw $100 in 3 years from now? The general formula So here note that you can simply revert this formula here, or this equation for the compounding rate, where you have the future value divided by 1 plus r over the time period. So here you have the following case. If the future value is $100 and the interest rate is 6% and the time period is 6, then if you're using those calculations, you get a present value of $83.96. That means if you are depositing $83.96 today in a bank account at 6%, and in 3 years, you're going to be able to withdraw $100. Now, the compounding and discounting interest is used for a concept which is called net present value. Think about the following situation, that there will be a cash flow of $100,000 in each of the next 10 years, and the interest paid is $6. Now the question is, if somebody were to offer you a lump sum payment today, the question is, well, what would be the net present value of that flow of payment? How much would that be today? And the general equation here is summarized in this formula here, where xt would be the $100,000, r would be the interest rate, and t would be the time period. Now note that this is different from the previous formula where we have the present value. So here you're only having $100 in 3 years, whereas here you are having $100,000 in each of the next 10 years. So here you have to use the summation sign that goes from 1 to t. Now let us consider how you can use this for a football field and the renovation of a football field. So consider that you have two options for the turf. First, you have the initial cost of $500,000 for the artificial turf, and it does require maintenance. It requires maintenance for 10 years. The natural turf requires that you spend $200,000 initially, but maintenance is required every year. So the maintenance cost also varies from year to year due to reseeding and fertilization. So note that here there's a typo. It should say, but does not require any maintenance for 10 years. Now assume that we have a discount rate of 5%, and then we have on the next slide, we're going to have the discount factor and the present value. Let us have a closer look at the football field calculation. Recall that we have the net present value, which is written like this, and that we also have the artificial turf, which has an initial cost of $500,000, but no subsequent maintenance. And then we have the natural turf, which has $200,000 at the beginning, and then cost of $20,000 every second year and cost of $50,000 every second year as well. Now the question is, how would you compare the artificial turf that does not require maintenance, the $500,000? How do you compare that to the cost? Here, you are going to use the net present value equation. So we have the initial cost of $200,000. The discount factor is 1, okay, since this is in the initial year, and hence the present value of $200,000 is actually the $200,000. Now, in a year from now, you have to pay $20,000 for maintenance. Okay. Now, the discount factor here is simply the 1 plus r over to the power of t. So that would be 1 plus 0.05 to the power of 1, since it is the first year. And hence that would be the discount factor of 1.05. Thus, the present value of $20,000 would be the $20,000 divided by 1.05, which is equal to $19,005. Okay, $19,050. Now for the second year, you have maintenance of $50,000, and hence the discount factor here is simply the 1 plus 0.05 to the power of 2. Okay? And hence, the $50,000 discounted at 5% for 2 years is 50,000 divided by the 1.1025, which is this term here, and hence the present value of $50,000 discounted 2 years at the interest rate of 5% is the $45,351.47, which is the value here. Now you have the present value. I have done the present value calculations here, and it turns out that the net present value of the natural turf is $467,435. Okay, and hence here in this case, when you're comparing the football field and whether you want to have the artificial turf or the natural turf, then the natural turf would be cheaper. Now let us calculate the monthly car or mortgage payments. Here you have to use this equation where P is the principal. So here we are going to do an example where the principal is $80,000. The number of years we are going to pay is 20 years, and the interest rate R is equal to 0.07. Hence, when you're calculating those values, note that you can plug in the values, then you are getting a value of $620.24. Okay? So this would be your monthly payment for a loan that is in the amount of $80,000 at an interest rate of 7% over 20 years. Now the next topic, which is a little bit more advanced from a mathematical perspective, is calculating the internal rate of return. Basically, the internal rate of return is where you have to find R, or the interest rate, which makes the net present value equal to 0. Now note that there is no equation where you can do that directly, and hence you have to use Excel to accomplish this task. Now let us consider the example of the internal rate of return. Suppose that we have an investment that costs $100,000 initially, and then over the next 10 years we are getting $15,000 every year. Now in order to calculate the interest rate that would make the net present value associated with this stream exactly $100,000, we have to use the function called IRR in Excel. That is the internal rate of return, where we simply mark the outlay at the beginning, the $15,000 for each in the next 10 years, and then we are calculating, or in Excel is calculating the internal rate of return to be 8.14%. What that means is if you were to discount the $15,000 over the next 10 years at a rate of 8.14%, then the net present value of that amount would be exactly $100,000. The last concept we are going to look at in this section is the so-called annualization factor. Now, suppose that you have an investment for initially $100,000 and that the interest rate is equal to 0.05 or 5%, and the lifetime, or N, the number of time periods, say is equal to 20 years. Note that the annualization factor does not depend on the initial capital or on the initial outlay. It only depends on the interest rate and the number of time periods. So for example, in this case, you take the 0.05 divided by 1.05 to the power of 20 minus 1 plus 0.05. And when you do those calculations, you get an value of 0.08025. Okay, so now what you can do is you can take this value and multiply it by the 100,000. So 0.08025 times 100,000 would be equal to $8,025. So that would be the annualized cost of $100,000 over 20 years at an interest rate of 5%. Now, let us move to cost-benefit analysis. So the cost-benefit analysis is a systematic method to measure costs and benefits of a project. Usually for the private sector, the cost-benefit analysis only involves private costs and private benefits, in a sense of what is the impact on the bottom line. In the public sector, we also have to include social costs and social benefits. Very often in private cost-benefit analysis, non-monetary costs and benefit are excluded. Now the steps are that we have to identify the objective and options, we have to identify inputs and outputs, we have to value those inputs and outputs, and then we have to calculate the net present value. Suppose, for an example, that you have a city that wants to make easier travel between the city and the suburbs. So here, the main objective for the city is to actually cut the travel time. Other potential objectives may be the reduction in air pollution, reduction in traffic congestions, or even the reduction in fatalities. The options here are that we have a commuter rail, that we can expand bus service, or expand highways, in the sense that we could have a carpool lane. The city should conduct a cost-benefit analysis in this case, and select the least cost option to achieve the objective. So how would this be accomplished? First, you have to identify the inputs and the outputs. For each of those options, we have inputs, we have costs. Think about, for example, for the rail that we have or for the commuter rail that we have to lay down the track. There will also be outputs or benefits in the sense that you could think about the time saved for commuters and also fewer air pollution, fewer car accident, fewer congestion, etc. Note that those inputs and outputs should be measured at first in physical quantities in order to avoid excluding non-monetary items. So if you're thinking about the example before, about the commuter rail, then if you have fewer accidents, then you have to provide an estimate of the number of fewer accidents that you actually have, without attributing any value to it at this point. Next, you have to evaluate those inputs and outputs. Usually, you want to calculate what is called the shadow price, which is the value to the economy. Note that the shadow price may not equal to market price due to market imperfections. So think about the following example. With the commuter rail, we would have less air pollution, but air pollution is not really, or clean air is not really something that we can purchase in a market. And hence, there's a different value to fewer air pollution to the economy that cannot be really measured with a market price. Next, you have to discount the benefits and the costs associated with this project. This also includes that you have to attach the dollar values to each of the inputs and outputs, and then calculate the net present value. And either you reject that project or you're going to accept the project. If there's a positive net present value, you accept, and if there's a negative net present value, you would be rejecting the project.